There are some lies that we tell about the stock market, especially to beginners. And the reason why this is dangerous is because when you are new to something, you can be quite impressionable. And I know when I started, I thought a certain way about things. And once you do that, it is very hard to let go of those things. So what are those lies that we tell new investors, and how much money have those lies cost us, and what is the truth? That is what we are here to discuss. And I'm gonna start shooting straight out the gate. The Intelligent Investor, which is on my bookshelf somewhere, is not one of the best investing books, especially for beginners. I would argue is mid. Okay, it is, and when I say mid, I mean like literally in the middle. It is not the worst book ever. It's not the worst book ever, but it's middle of the pack. A lot of people hold it up as the golden Bible of what it is to be an investor. So number one, if you are brand new, that is the last book that you want to read because it is quite complex. It's obviously close to 500 or 600 pages. It's just not it is not beginner friendly at all. At all. It's not where you want to be. And two, it's really outdated. And Benjamin Graham, on his way up out of here, he has said that a lot of that stuff was outdated as well. And there have obviously been some revisions to the book over the decades, but it hasn't stood the test of time. There are some parables and some stories in there and some lessons that I think that is what people are remembering about the book, and that is what stands the test of time. But the issue is a lot of the formulas in there to determine whether a stock is valuable or not is not worth it. And for beginners, it's just not, it's not it, even though Warren Buffett endorses the book. And number two, speaking of Warren Buffett, he is not the world's greatest investor. And I'm not the main person, but I am guilty of saying that he is known as the world's greatest investor. And you can call that a lie or not. He is known as the world's greatest investor, but he is actually not. Jim Simmons has lapped Warren Buffett in terms of returns. Jim Simmons was a hedge fund investor. His returns were close to 60%. 60% is what that man was making, whereas Warren Buffett was known for making right around 20. You tell me, would you rather make 60%, I mean, we're talking averages here, averaging 60% a year, or 20% per year? Now, why was one a lot more famous than the other? There are a lot of reasons. Number one, Warren Buffett started way earlier. Warren Buffett started in his mid 20s. So Buffett had years of compounding on Jim Simmons. And this story was told in The Psychology of Money. So that is where I'm pulling a lot of this information from. But that's one part of it. Jim Simmons, I don't think really started until his 50s. And he recently passed in 2024. So he started in his 50s, died in his 80s. He only had 30 years of compounding, whereas Warren Buffett, at the time I'm doing this video, December 15th, he's still with us. So he's been doing this for way longer than I've been alive, obviously. And I think Warren Buffett is at least in his 90s. So he's been doing this for well over 60 years, probably going on 70 years at this point. Compounding for 70 years versus someone who started in their 50s. That is one reason. And obviously Warren Buffett's net worth, I'm just going to throw a wild guess, but I'll put the exact number here. His net worth was well over 80 billion. I'm sure it's close to 100 billion or whatever it is today. Whereas Jim Simmons did not reach that number. And another reason as to why those numbers are different, Warren Buffett did Berkshire Hathaway, which bought up shares of other companies. Whereas Jim Simmons, who started at a much different amount, started off at 50 and started off with just the hedge fund and didn't grow to the amount that Warren Buffett did. It's truly a function of being in the game longer, being able to acquire different companies and get bigger and more famous. That is why we know the name Warren Buffett. And you can't tell me exactly what Jim Simmons looked like or the fact that he had just passed in 2024. That is the difference between the two. What does that mean from the solution standpoint of learning from Warren Buffett or learning from Jim Simmons? Well, I would say this. We do know that Warren Buffett has already retired, right? We're not going to be getting annual letters, which I'm going to miss. We're not going to be able to get a whole bunch of new content, right, from Warren Buffett and what we can learn from him and what he's going to invest in. We're not going to have that anymore. I've been saying this for a while, and I've already started to pivot. I've been doing this for years now because I knew it was going to happen eventually, right? I think you should be trying to follow the big money regardless of who it is. And I don't mean just following blindly, hey, this person's a billionaire, they're buying this. No, I mean, look for insiders. These are CEOs. These are people who are on the board, because studies have shown when they buy, they tend to beat the S&P 500. They are going to know more than anybody else. They know the company. There's only one reason as to why they would buy. And there are ways for you to find that. I've done a whole video on how you can find the information. So that's number one. And then you can check for these hedge fund managers, and when they buy too, they have to release what is called a 10F, if I remember correctly. That's the form you want to look for. It'll show you, hey, we bought this, we sold this. Again, buys and sells can tell you some information. You'll also look for this for Congress too. Congress's trading can be, some are better. Some Congress people are better than others. But again, it's the buy side that I am paying attention to. It's one reason as to why you buy, because you think it's going to be more valuable. You think that thing is going to go up. Another lie that we tell, and it is an interesting one, is, and maybe it's from Warren Buffett, maybe it's from the book, is this. Think of yourself as a business owner. When you buy the stock, you are a business owner, and you need to think of it like that. That sounds great, and it is technically true. It is technically true, because even if I buy $10 worth of Target, I do own it. I am a shareholder. I do have rights as a shareholder. Now, I am never going to own enough to walk into a boardroom of one of these major Fortune 500 companies. But most of us aren't good at taking a business to that level and knowing, more importantly, what impact that's going to have on the stock market. It's only 500 companies. Therefore, it ain't but about 500 people that have experienced what it's like to do that as a business owner. Like, I run a business. My business ownership doesn't have too much to do with me as an investor. That my investing track record and my business ownership, there are a lot of small business owners that ain't good investors. Those two things don't equal each other. And to prove that point, I'll say it like this: thinking of yourself as a business owner. Let's say that you own a dating website. The dating website, the entire point is share videos from back and forth between participants, and the target market is early 20s. From 22 to 29, and you share video messages just like this from point A to point B. That's it. That's how you match. You send a video. That's a whole video message, and that's it. Okay, and this is early, let's say 2003, 2004-ish, before FaceTime, right before Skype-ish, right before YouTube existed. It fails. And instead of throwing the app away, you say, all right, before apps. Before you do that, you say, what if we just turn into a different type of site, a social site, and we just let everybody just upload whatever, and we just make it a social thing, I guess. And we just let people just upload whatever they want to upload to the site and call it a day. That thing became YouTube. Would you have thought that that was it, or would you just have given up because no one used your website? And would you have been able to say, hey, we're going to end up selling it to Google? Or would you have been the person to not sell your website and end up failing because you thought you would have been better off? That happened to MySpace, right? Sometimes you don't know, because as a business owner, you may think one way, but as an investor who manages a portfolio, you may think a different way. And neither one of those sometimes is the right answer, because I need to think about how the market is going to respond and how the economy is going to respond. That is the actual answer. When we're looking at, is Target going to do well in 2026, or how AI is going to do well in 2026? A part of it is, okay, how many people are buying and selling? True. But it's all right, well, how are tariffs going to respond? What policies are passed? That's external from the company. That is how I really should be viewing it. Instead, I would say that you want to have a system as an investor and have a checklist for what it is I'm buying, why I'm buying it, and when and why am I going to sell. That's what's going to help you to not look at it as a business owner, but look at it as an investor and look at it as a manager of your financial future. That's what you have to do. And that is who you are, because you will be managing your financial future. You're not the CEO of company A, B, or C for that matter. And I think that's the biggest part of it. Like, if I, again, there are ways I could put myself in those shoes. Like, if I'm the CEO of AMC, right? I don't know if I would own that business, and I don't like some of the decisions that they make. But again, yeah, that might prevent me from owning it. But also, there are other companies that I might not agree with some of the decision making, but the stocks are still good. Netflix, for example, you can go back to some of my videos from 2022, and Netflix was going into gaming. 3 years ago, 4 years ago, I wasn't really happy with what Netflix is doing. I've changed my tune because the situation has changed. There's been a lot of Paramount Plus didn't exist back then, right? And then we had the whole like a lot of things have changed. But if I saw it as a business owner, I wouldn't have gone into gaming. There's a lot of decisions that I personally would have made because maybe I'm not the best business owner of a streaming network, but I am a much better investor, and I do have a much better process. If you want to know exactly what process you might want to consider as an investor, then this is the video that you want to check out next.